Hi, we're going to start our adventure into chapter six, which is the first of two chapters about business formation and small business. And we'll talk more about small business in chapter seven, but chapter six is a good springboard of what we can expect in chapter seven. So let's go ahead and get started. So there's different types of ownership that we're going to be talking about. There's actually several types. We're going to focus on four primary ones. This first one's sole proprietorship. That is where you own everything. So you are the accountant, you are the marketer, your sales rep, your maintenance. You do everything. And typically the sole proprietorship is going to be that person's sole amount of income. And it's challenging, but if you can do it, if you have the drive, then you can make a lot of money that way. Another one we'll talk about is going to be the partnership. Partnership is again when you get someone who can help you out. Maybe you're good at accounting, someone else is good at sales, or maybe someone's good at marketing and you are good at fixing things, whatever the case may be. So it's a way to complement each other. And one thing about partnerships is that you don't want someone who's like you. You want someone who has a little bit different viewpoint and has a different skill set than you. Corporations we're going to talk about. Corporations are entities that almost have a life of their own. There's a lot of shelter with corporations in that the corporation pays for any liability, saving the individuals who may own that corporation any type of loss of personal assets. There's a limited liability corporation, which is typically what you see for smaller corporations, very similar to the corporation, but this is on a much more smaller scale. So if you were to start a business, the first thing I would tell you is get an LLC, have that limited liability corporation, take the liability off your personal property, and also you can see in the slide, you do get some tax breaks with this. On the slide here, you can see where sole proprietorship make up many of the small businesses, and we'll see in the slide that sometimes that ownership, small businesses come out of necessity where individuals lost their jobs, they got to figure out a way to survive, and then they come with their own businesses. So let's talk about the advantages of sole proprietorship. It's easy to start. You could start a resume business right now. You could go to any college and say, hey, I'll offer a type of paper for you if you had the laptop. So there's one of those things that you can do. Retention of profits, absolutely. It's your money. You earned it. It's a sole business. However, there are some disadvantages. Disadvantages could be one, it's unlimited liability. You're not corporated. So if you are driving and you're doing something for your business and you hit someone, you are still liable for that. You personally, not the company. And you and the company are basically the same here. Um, the heavy workload responsibility, that's true. As I mentioned earlier, you're everything. And it takes a toll. It's very stressful. But people do this all the time. And if you are interested in it, I bet you could do it as well. Partnerships. There's no limitation on the number of people in the partnerships. Usually when we think of partnerships, it's like two, but you can have six, you can have seven, whatever. And again, the partnerships should bring a separate skill set to the business so that everything's a complement and maybe get some overlap. Because if you get people who think the same, the chances are is that the error is going to occur because everybody thinks the same and that they're not looking at something through a different lens. And it's possible that you get bias, and that could be some issues for the business. Some advantages to the partnership. As you can see here, you pull the resources. So if you have like 10 people, everyone can chip in the same amount. Or if there's like a percentage of partnership, they can get a proportionate amount of ownership based upon the money that they put into the business. Ease of formation, absolutely. We can go in and similar to the example I gave you with the resume writing or also typing papers, if you have a computer and I know people, we can get together and start a partnership that way. So they're very easy to format or very easy to start. I'm sorry. Um, there is unlimited liability because again, we didn't incorporate. Very similar to the sole proprietorship. If something were to happen, we will be responsible for it, not the business since we're not incorporated. There is a potential disagreements. You know, Conflict is okay when done correctly, but in partnerships, when you're dealing with money, you're dealing with livelihoods, things could escalate quickly. And so you want to make sure that there's a charter, there's a way to resolve disagreements. So if slash when, and they will occur, you have a way to resolve these and can move the business forward. Limited partnerships. Basically, this is where one partner has a controlling stake. There's silent partners. So, for example, if we were doing a partnership and you were the primary source of partnership, maybe you have 80% of wealth into 80% of money into the corporation. I have 20%. You have a huge controlling interest, and you have the right to basically say how that business is going to go. Let's take a look at corporations. There's the C corporation, which is kind of the one that we're really familiar with. The C corporation is the larger businesses. And as I mentioned earlier, these have a life of their own. And you can see in the slide, the limited liability to all of its owners. The corporation protects the ownership from harm. Now, it's not to say that the person did something deliberately that they would be charged. Absolutely. But fender bender, accidents, that might fall under the corporation rather than the personal assets. The corporate bylaws, it's just simply, think about a constitution. That is what the corporate bylaws are, how the company is going to be run. Now, if you see here down the bottom point, it could vary by state. So Wisconsin may have one set of rules, Michigan may have another set of rules, Illinois, et cetera. So make sure that you know the laws of the state in which you are participating or opening your business. All right, I think have a pretty idea what a stockholder is. A stockholder is an individual that invests money into that business for return of shareholder growth or growth of the stock. And so we take those investments seriously. Retirements are on that. 529s, which is savings accounts or investment accounts for kids schooling. So stockholders are very important, and publicly traded companies will solicit these as much as they can. Board of directors. There's a misconception what the board of directors do. A lot of people think that the board of directors sets the strategy and they're the ones that really run a business. That's not true. What those board of directors will do is they are elected by the stockholders and they protect shareholder interest. They will hire the CEO, and the CEO reports to the board of directors. The board of directors has the right to extend the contract for CEO or to dissolve the contract for the CEO. Again, it's all in the interest of shareholders' wealth and shareholder interest. So there's some advantages and disadvantages. One of the advantages, of course, is that the limited liability. Um, we've talked about that quite a bit, so I'm going to leave that one go. The idea of raising financial capital, if you are a publicly traded company, absolutely. If you have a good business plan, you plan to incorporate, you don't have a lot of debt, you possibly could get a huge loan from a bank. It might be easier for you to get the business started. Now, some disadvantages, the double taxation. That's of earnings and also of property, machinery, equipment. So if you make purchases, that would be taxed as well. But we're going to see a corporation soon where that's not the case. Possible conflicts of interest, sure. We may see where a CEO of a company will act in one way but say something in another publicly, and he says something publicly to try to persuade the stockholders and employees to go one way when he knows that's not right, and he'll go another way to protect himself. We've seen that before. Enron's a classic example. This is the one I was going to tell you about how corporations can. One of the advantages is not have as much tax. The S corporation. The S corporation is one that avoids double taxation. That only taxes the income. I think you have a pretty idea what a non-profit is, so I'm not going to go too much into that. And the statutory or closed corporation, um, there's not as many stockholders with this, and we'll see it's less than 50. We'll see that in just a couple seconds. So in terms of the S corporation, the stockholders have limited liability with this, so they don't have any sort of liability if something were to happen. And of course, we talked about the taxations. The limitations, they can't be more than 100 stockholders in an S corporation, okay? It's limited simply because of that taxation rule. Now, we talked about the closed corporation. We'll start with the limitations first, can only have 50 people. As we go into the key advantages, that last one, where it says ownership can actively participate, but while still having limited liability. So they can take part in the organization, but their property is still not at risk. It's only the corporation itself, because again, it has a life and entity of its own. Nonprofits, I think you're pretty comfortable with. You know already. They're exempt from taxes. Now you're probably saying to yourself, okay, a nonprofit organization still has to make profitability in order to survive. 100% agree with that. But they put those profits back into the organization, and so that's why they're not being taxed. Limitations on it: you can't distribute dividends. People may want to contribute, they may want to donate, and that's great, but they can't expect anything in return. Oops. We talked about that. Oh, sorry, I got a little bit happy with my mouse. Okay, so in regards to restructuring, there's a couple different ways we can do this. Acquisition, basically company A buys company B. Merger, company A and company B marry, and they try to make the best of both worlds. They try to take the best company A, best company B, and put it together and come up with a new organization. About 33% of these are successful. A third of them have failed due to culture. There's a classic culture where culture A and culture B, they will not fit together. There's no synergy there, and a merger will fail. Horizontal merger is where two organizations within the same space will merge. So you can think that dry cleaner A and dry cleaner B, they merge together. That's a horizontal merger. Now, the vertical merger is that if I am a business, let's say the dry cleaner, for example, so we're dry cleaner A, we can take a look at this and we can get someone who manufactures soap. That would be an example of a vertical merger. We're still taking over that soap company, and it's part under our umbrella in terms of organization. So that's an example of a vertical merger. And later on in the course, we'll talk about a vertical company. A divestiture is basically where people will get rid of their part of the company. If the company is not doing well, people will bail. If their interests are not aligned with the organization, they will leave. All right. So it's where a company doesn't want to, or a stockholder does not want to take partnership or part of that organization. All right. This could go to business to business. Like we want to spin off, we're company A and we want to spin off company D. D doesn't fit in our plan anymore, so they're on their own. That's the divestiture. That's easy for me to say. Okay, the LLCs, the limited liability corporations. If you start a business, like I mentioned before, the first thing you want to do is incorporate. And the limited liabilities give you a little bit of a umbrella protection to help so you're not losing your house, you're not losing your car, anything like that, your savings. And as you can see in the point here that every state's different. We talked about that from one state to another. So make sure you check the regulations of how to do business in that state before you start. The idea behind the LLC, the advantages, of course, there's flexible ownership involved. You can have partners in this. You could be a sole proprietor. So these are things that you can take a look at that might be an advantage. The disadvantages is that it takes time to fill out the paperwork. You're going to need lawyers. You're going to need, uh, po- depending upon the situation, you may have to go through an auditor. So there's lots of things that you have to do to make sure that this LLC works, but it's going to cost you a lot of money and time. And as we see here down at the bottom, there's differences in state laws. The franchise. The franchise is simply where we buy the rights to own a company that's existing. So the classic example would be McDonald's. We have $250,000. I'm just making this number up. We have $250,000. We want to buy a McDonald's franchise. They'd probably accept our bid, depending upon where it's at, of course. The franchisor is the business that's being bought. So McDonald's, for example, a franchisee is the one that pays for the right to use that business. Now, the thing that we have to consider with the franchising is that even though we own our own business, we're still subject to how their marketing is, which we have no say, their products. And the other thing too, to be careful of, is that if there's an issue with a franchise anywhere in the area or across the country, it could reflect badly on you as well. So in a distributorship, what's happening is the franchise is going to say, hey, we got this product, the X3000. You got to sell it for us. Okay. You're selling this product for us. So going to McDonald's, the burger, you would sell the burger for McDonald's. As we get into franchising, you see some really positive numbers here. Women sole owners up 26%. That's great. Minority population franchises is growing. So this is really good. So franchising does work if you have enough capital to invest in this franchise, because you're buying a name, you're buying a brand, and you're buying already existing product and a process. So that's really good. In the franchise agreement, you see there's less risk involved because you're looking at something that's already been successful. The franchise disadvantage is its cost. You don't control it. It's still, yeah, you control your business, the hiring, letting people go, but it's still the marketing for the corporation itself, and it's also their product. In regards to the franchise agreement, again, it's just a contract that says, hey, Rich, you're buying McDonald's. McDonald's is saying, this is how you're going to do our business. This is how you're going to run our business. And we'll say, okay, we'll do that. That's the price to pay. And you can make a lot of money off franchises, especially if you get like a really good location. Oops. And we're going to wrap up. We're going to wrap up with this slide. And so you see the ideas and agreement, the terms and conditions, how many days you're going to be open, when you're going to be open, what you're going to serve specific times. Again, looking at the restaurant industry. How you're going to train your people. You probably have a corporate guide telling you how exactly you should be trained. Or probably going to be online training that you have to do or your new people have to do. Assigned territory. So you may only be assigned a certain area, and that's the only area you can work in. So that's got to be, that's going to restrict you a little bit from growing, but still you are buying the name, you're buying the brand. So franchising works out pretty well. So that's our discussion of chapter 6. I hope you liked it. And as always, please let me know if you have any questions. Take care of yourself and have a great day.